Welcome back to Econ IQ. In a market full of volatility and noise, we do not chase superficial excitement. Rather, we focus on the deeper picture. We present to you daily a well-studied financial vision that helps you see further, move with steadiness, and protect your wealth for a longer period. Yesterday, Trump returned to his usual style, taco. Trump always chickens out, meaning a last-minute retreat. And with his surprising softening of his position regarding Greenland, fear in the market quickly receded. Gold moved violently and fell from its historic peaks by as much as $130. This fluctuation worried many short-term investors, but was this event surprising? If you watched Monday's video, you will not be surprised, because we explained then that Trump's noise about Greenland is merely a tactic of maximum pressure to gain negotiating cards. Trump is not planning a real war, and as we expected, the market moved according to this scenario despite the current noise. Many are now asking, Trump admitted that he was only posturing, so why do we need hedging? Should I sell gold? And the answer is clear. Do not let short-term shocks blind you. This pullback may be a healthy and necessary correction before gold heads toward $5,000. Why this optimism? Because what happened in the past 2 days is deeper than a mere price move. We are witnessing a disintegration in the global political system after World War II and the beginning of a major transformation in global capital flows. Will the market continue to fall, or will we witness a sharp rebound? Do you act out of fear and exit, or with awareness and reposition? That is why we consider this stage a historic opportunity, and after this video you will understand why we said that what we are seeing now is the calm before the storm. Hold steady and adjust your perspective, and let us begin analyzing the reasons for gold's sharp decline yesterday. The reason returns again to Trump, who revived the presentation of the art of the deal. On Monday, he stirred an uproar on social media, announcing his intention to buy Greenland and threatening Europe with tariffs, and the world was on the brink of war. At that time, gold rose strongly and U.S. stocks fell. But in less than 48 hours, the scene changed completely. At the Davos Economic Forum in Switzerland, Trump delivered a calmer speech which restored reassurance to the markets, and in a somewhat conciliatory manner to some extent. Trump explained that the United States does not intend to acquire Greenland militarily, and after this statement, the danger of war vanished, and he confirmed that the solution is immediate negotiations. He added that he will not impose tariffs on Europe at the present time, but spoke about a framework for future agreements. A familiar taco moment. The aggressive Trump on Twitter disappeared, and in his place came Trump ready for negotiation and settlement. At the same time, his role in lowering interest rates began. The economic logic is simple. Gold does not yield interest, and holding it has a cost. The S&P 500 index rose by 1.20%, and it was one of the biggest one-day gains since November, and bond yields rose, which led to selling safe haven assets. Gold, as the most important safe haven, bore a heavier burden of selling and suffered a sharp decline. And this confirms what we said on Monday. Trump's escalation over Greenland is a maximum pressure tactic to gain negotiating cards. When opponents such as Europe show firmness, or when Trump feels he has gathered enough cards, he retreats, declares victory, then withdraws. But does this mean the world suddenly became safe? Of course not. Has gold's role as a safe haven ended? Absolutely not. It's true that Trump's tactics may achieve short-term gains and lift stocks temporarily, but in the long run, this behavior destroys trust. It harms allies, belittles international rules, and triggers what is known as a collapse of confidence. Every time Trump cries wolf and every new taco moment drains the national credibility of the United States. This accelerates allies' distancing and increases global investors' doubts about dollar assets. The matter resembles a partner who puts a gun on your head to force you to sign a contract, then later says, "I'm joking." Will you trust him again? Of course not. You will start searching for alternatives, moving your money, and looking for a safer financial umbrella. Here lies the reason for gold's strength. When hegemony fails and rules are broken, gold becomes the final refuge. To confirm that, we must look at the Davos Forum. This meeting may be recorded in history books as a turning point in the global system after World War II. In Davos, we no longer hear slogans of globalization and profit for everyone, but we hear the anger of America's allies and the sound of the old system cracking. Let us begin with Canada. The Canadian Prime Minister Carney delivered a strongly worded speech at Davos. He said clearly that Canada strongly opposes the U.S. tariffs linked to Greenland, and this is a very heavy phrase diplomatically. He indicated that some major powers, headed by the United States, use tariffs and the financial infrastructure as tools of pressure and coercion. He warned that institutions of the global system, such as the World Trade Organization and the UN, have become threatened. And then he issued an explicit warning for medium powers to wake up, and this is a call to countries like Canada, Australia, and Europe to realize that the United States is no longer the only power. He affirmed that the international system based on rules after World War II is collapsing, and that the world is heading toward zero-sum conflicts among the great powers. In this new world, strong states do what they want, and weaker states pay the price. And in Davos, in front of the global elite, the Canadian Prime Minister publicly described the United States as a destructive force for the existing order. What was considered impossible 10 years ago, even 5 years ago, has today become reality. Similar voices began to come from Europe, especially from France. French President Emmanuel Macron delivered a speech in the same direction, and in the face of rising transatlantic trade tension, he did not choose silence or anger. Rather, he confronted what he described as the diplomacy of bullying politically, and at the same time extended the hand of economic cooperation toward the East. Macron was realistic. Europe is no longer able to rely fully on American security or American markets. Therefore, Europe must seek strategic independence. This is what makes the Davos Forum extremely important. It points to a structural transformation in global politics and finance after World War II. The crack within the Western alliance has become public and familiar. And as allies begin to question the existing order and the dollar, that turns into permanent fuel for gold's rise. In a world without trust and without rules and with discordant allies, gold remains the last and enduring pillar. Despite short-term pullbacks, I am more optimistic about gold's long-term direction than ever before. There are 5 main reasons supporting gold's rise and perhaps it's reaching $5,000. First, the strongest buyers today are those who doubt the stability of the dollar and the major reserve currencies. For them, gold as a hard currency across thousands of years is the best store of value and a hedging tool against shocks. Second, Trump's aggressive policies, from military threats to weakening the independence of the Federal Reserve to using tariffs against allies, all weaken the credit foundation of the dollar. This is what Wall Street calls the currency devaluation deal, where fears grow about losing fiscal discipline, failing to control inflation, and swelling debts. Third, in early 2025, with the imposition of intensive tariffs, the dollar index fell 12% within 6 months, and now history repeats itself. It is not just $1. Eurozone debt exceeded 120% of GDP, and Japan's debt reached 260%. When the major currencies become rotten apples, gold becomes the golden apple, as an analyst at TD Securities said. Gold's rise reflects the collapse of trust in the global credit system, and when the trust system collapses, gold's rise may surpass current levels by far, and 5,000 may be only the midpoint of the road. Fourth, with the economic slowdown and political pressures, the Federal Reserve began its rate cut cycle. The logic is simple. Gold does not yield interest, but with falling rates, the cost of holding it decreases. When rates were high and bonds yielded 5%, gold retreated, and with falling yields, gold becomes more attractive. Fifth, Goldman Sachs data revealed something shocking. Gold fund holdings represent only 17% of American financial portfolios. If only 10% of money market fund assets out of $77 trillion shifted to gold, the price could break $5,500 per ounce. This redistribution of funds could be enormous and unprecedented. Finally, central banks are no longer sellers of gold. Rather, they have become steady buyers regardless of price, especially countries like China and Russia that accelerate converting their reserves from the dollar to gold to avoid the weaponization of the financial system. According to World Gold Council data, the People's Bank of China will increase its gold reserves by 280 tons in 2025 for the 18th consecutive month. Not only China and Russia, but Poland and other European countries are increasing their gold holdings to support their currencies and stabilize exchange rates. The Polish Central Bank announced its approval to buy 100 tons of gold. This behavior strengthens demand and sends a strong bullish signal to the market. Even those who print money buy gold. Gold reached new peaks in tandem with global stocks, but high stock valuations stirred widespread concern. The CAPE ratio for the S&P 500 reached 38 times, a level historically exceeded only before the dot-com bubble in the year 2000. Technology stocks became the heart of the bubble. The Magnificent Seven stocks represent more than 35% of the S&P 500 in a winner-takes-all model. On January 20th, these 7 stocks closed on a collective decline, and $683 billion evaporated in one day, and small and mid-cap stocks also fell. This indicates investors exit from highly valued technology stocks. Where does the money go? Bonds carry inflation risks, real estate suffers from a lack of liquidity, and digital currencies are highly volatile. Gold, as a traditional hedging tool, naturally attracts funds, forming a seesaw between stocks and gold. The psychological factor is important. Historically, gold uptrends are long and powerful. Citigroup found that after annual gains exceeding 20%, gold rises in the following year by an average of 15 to 30%. This pattern repeats in 2025 after a rise of 27% in 2024. From a technical perspective, after gold broke the 4,500 level, it follows a healthy trend: breakout, consolidation, rise. Yesterday's decline was a textbook correction. Moving averages are still bullish, volume is increasing, and trend-following funds are entering the market. Institutional optimism is at its highest levels. Goldman Sachs and Citigroup raised forecasts to $6,000 to $7,000, while Saxo Bank sees as high as $10,000. When a Wall Street consensus forms, the driving force becomes enormous. So how does the ordinary investor act amid this rising market and taco volatility? My philosophy is simple in 8 words: follow the trend only and ignore the noise. Trading volatility is difficult. Prices fluctuate, and chasing breakouts may trap you. You think you're at a bottom, then prices fall further. These moves are false signals. This harms active traders who try to capture every move. My advice is clear: ignore the noise and trade only clear trends. Do not worry about small profits if the trend is unclear. Stay out of the market currently. Gold rose very quickly and needs a rest. Support is near 4770 and strong resistance is between 4850 4900. The price moves within this range. In the long term, global instability supports gold, and in the short term, the market needs to digest gains and shake out weak hands. In such periods, not trading is the best trade. Fewer mistakes, safer capital, and a calmer mindset. This is much smarter than trying to predict the next move. So, when do we move? When the market chooses its direction clearly. There are only two scenarios. The first, gold builds enough strength to break 4850 and hold above it. This means the beginning of a new uptrend that one can ride. The second, gold fails and breaks 4700-150, which signals a deeper correction toward 4700 or lower. In this case, better long-term buying opportunities appear around 4600 or 4500. Outside these two signals, if the price remains within the range, it is better to remain without action. Patience is the key in trading. Focus is more important than technique, and discipline is more important than prediction. Opportunities never end, but patience is rare. If you plant in your mind the rule avoid ranges and follow trends, you will avoid 80% of market pain. Conclusion: although Trump's style caused short-term volatility, he cannot change the broader collapse of the global system, nor can he reverse the long-term decline in the dollar's credibility, and he cannot stop central banks' rush towards gold. Gold reaching 5,000 or even 6,000 is historically almost inevitable. For the ordinary investor, this pullback is not a disaster, but a gift. A time to think, prepare, and organize the mind. If you feel anxious or exhausted, stop for a moment, close the screens, and calm down. Our goal is not to trade every day. Our goal is to be ready with capital, clarity, and decisiveness when the clear trend appears. We stand at a historical turning point and a major redistribution of wealth. Patience, time, and steadiness are the keys to the prosperity of wealth. A final reminder, this analysis reflects my observations only and is not direct investment advice. Markets involve risks, and each person is responsible for their decisions. If this analysis helped you, write your opinion in the comments, and do not forget to like and subscribe to ECON IQ and share the video with those who care about money and markets. See you in the next video. Goodbye.